This is for the results for the year ended September the 30th. Here's some of the highlights. Revenue up 11.5%. South African profits. South Africa doing well, up 21.5%. Adjusted headline earnings per share up 8.7%. In the Power Lunch Johannesburg studio is Dr. Richard Friedland, who's the CEO of Netcare. Richard, thanks very much for joining us. While my concentration is finally honed, maybe we could get into the situation in the UK, and I'll read you the first part of your commentary today. The financial results have seen a strong and improved contribution from South Africa, but then you go on to say the results have been impacted by certain material non-cash adjustments relating to the general healthcare group portfolio of 35 UK hospitals, properties initially acquired in 2006, and you go on to talk about ring fencing. In layman terms, can you tell us exactly what this means and what it is?
Yes, thank you very much, Lindsay. As you pointed out, we've had an extremely strong performance in South Africa, and we've also held our own operationally in the UK, but there are some accounting changes that we had to take account of, and hence these material non-cash changes which impacted our earnings overall. I think it's important to stress that we didn't default on any debt. We have a performing loan in the United Kingdom. We've met all of our covenants. But because we haven't refinanced our debt as of the end of September 30, and there's a maturity date at the end of next year, October 2013, from an accounting perspective, there was a certain uncertainty, and this resulted in a number of these changes coming through in our results. I think what is very important for our shareholders and the market in general is that post the year end, the board of Netcare felt that it was no longer appropriate to consolidate our properties in the UK. This is the company that holds some 1.5 billion rands of debt. And as a result of that, we released today a pro forma, a statement of our financial position, which will no longer consolidate these properties. They'll be equity accounted as an associate. And so probably some 27 billion rands of liabilities will come off our future balance sheet. And I think that's the real take-home message for our shareholders and indeed those people who are concerned about the UK. The second important issue, Lindsay, is that the new capital structure or the new income statement of our financial position is far more reflective of the capital structure of Netcare and also reflective of the fact that this debt, irrespective of when it's due to be refinanced, has and remains non-recourse and ring-fenced non-recourse to South Africa and completely ring-fenced to the United Kingdom.
Some people, of course, when they see the phrase ring fence, they think, well, there's something bad there and it's got to be kept away from the good stuff. But again, that's people that haven't heard that explanation, but you can understand their concern.
Well, you know, if you take it back to when we did the acquisition at the height of the market in May of 2006, we were very clear that any investment made offshore should have no impact on South Africa or South Africans' earnings or put our balance sheet at risk. In fact, it was a prerequisite of the South African Reserve Bank at the time, and indeed the Security Regulatory Panel. So you could argue that we took a worst-case scenario into account back in 2006, and it's borne out in today's results in that, yes, there is debt in the UK, but it has absolutely no commercial impact whatsoever on our South African operations or the strength of the Netcare group.
Well explained. Thanks very much for that. It's cleared up certain things in my mind. Anyway, while we're on the subject of the UK, we may as well start the operational review with the UK business. I mean, the UK's in recession. It's as simple as that. But I'm interested to see the fact that the recession has had an impact on the business. I mean, when people have less money, do they say to themselves, well, actually, it's a bit of a luxury for me to get this treatment or to attend to my health? What has been the behaviour of your UK customers?
Well, I think just looking at the UK, GDP is down some 6% in the UK since the recession in 2009. And private medical aid or private medical aid insurance is at its lowest in the last 20 years. So people are defaulting to the national health system. And we've also had a structural change in our business in that now 30% of the work we're doing are national health care patients, which augurs well for us as the NHS is under pressure. And this used to be a business that 97% of the work we did was private. Now only 70% is private. And about 30% at much lower margins and lower revenue comes in from the NHS. So all of that in the melting pot gives you the kind of results which are not sterling, but we've held our own in a very tough market.
And it probably makes you all the fitter and leaner for the future when the UK economy does eventually pull out of its malaise with its austerity measures. Presumably you'll be set fair.
Exactly, and shame on us if we don't emerge from this very deep double-dip recession and difficulties within the United Kingdom a lot leaner and fitter and able to leverage off an improving PMI or private market going forward. Absolutely correct.
Let's have a look now, Richard, at the good news. The sterling performance on the South African operations side. Where do you want to start?
Well, I think overall, if you look at the South African operations, they've been largely driven by demand. We've had an increase of revenue, some 9.3%, but excellent operating leverage, and our EBITDA up some 11%. We had strong demand in primary care with improved efficiencies. But I think the most important thing is that this increase in revenue was driven by demand because a lot of our input costs, be it on salaries and utilities, are way in excess of the kind of tariffs we're able to get from the medical funders. So overall, a very good result. We remain very cash generative, in fact, both in the United Kingdom and in South Africa. And as a result, we're able to declare a dividend here in South Africa up by 10% of the final dividend.
Yes, 9.7%, which is very gratifying indeed, and shareholders will applaud you for that. How do you grow your business, Richard? Is it simply increasing the number of beds, improving margins?
Well, we are increasing the number of beds. We added 190 beds, although on average it was 97 because those beds came in the second half, and we will continue to increase beds. But for us, we're a very highly sophisticated, high-tech network. It is about expanding the services we offer and also looking to increase the occupancy in our current facilities. That's a major focus, and we've embarked on an 18-month rollout of an efficiency program that we explained to the market in May, and we gave an update today as to progress there. And so we do believe there's some more to come as a result of that.